Hello, welcome back. Thanks for stopping by. If you are new here, my name is Jessica Abella. I am a tax professional in the greater Seattle area. And today we're going to talk about why S Corps are not always the answer. I see frequently in social media, I hear from clients that they're hearing out in the wild that they need to make an S Corp election for their LLC. And this may be the right thing for them to do, but 9 times out of 10 right now, that's not the answer. And so today we're going to talk about why consultants think that it is the right answer and why it may be short-sighted to make that election, especially in this moment in time. First, a couple of housekeeping things. There are intricacies in this that I cannot possibly fit in this short video. I would have to speak for hours to get all of the intricacies in. Please, if you are in the situation where it may or may not make sense for you, please consult your tax pro who can look at your full tax situation and, most importantly, your goals to give you an idea if this really might be the right direction for you to go. Also, we're really talking about comparing having an entity that is taxed as a sole proprietorship versus being taxed as an S corporation. And that can mean either that you have a sole proprietorship and you're considering starting an S corporation, or if you are set up as an LLC, your LLC can do either one. By default, if you're the only owner, it's taxed as a sole proprietorship. If you file an election, it can be taxed as an S corporation, the same LLC. So with those ground rules, that little bit of housekeeping out of the way, let's talk about why consultants, why social media in their little sound bites say that the S Corp is the answer. And in most cases, it comes down to one provision. When you are taxed as a sole proprietorship, you are paying Social Security and Medicare taxes on all of your profit up to the upper Social Security limit. So $170 some odd thousand goes up every year. So let's just keep it simple and talk today about this business that's making $100,000 in profit, okay? So this business making $100,000 in profit, the Social Security Medicare tax on that at roughly 15% adds up. It's $14,130. So that's a significant amount of money, and it's very painful to pay that on top of your income tax because, of course, as a self-employed person, you're not paying any of that automatically throughout the year. You have to consciously make quarterly estimated payments to get that money over to the IRS. It's very painful. I understand that. So the concept is that when you are taxed as an S corporation, you as the owner are required to be on payroll, and you're only paying that Social Security Medicare tax on your wages. A lot of advice out there is to pay yourself as little as possible through wages that you're paying Social Security Medicare tax on, and then you don't have to pay Social Security Medicare on the rest. So if you are paying Social Security Medicare on, say, $60,000 in wages when you had that $100,000 in profit, maybe you're only paying $9,000 in Social Security and Medicare instead of $14,000. And not only that, because you're in payroll, you're paying that every pay period with most payroll systems, so you don't even really notice it. And that, honestly, is the biggest reason that regardless of tax savings, if it's really helpful to you, if that's so burdensome for you to set aside the tax money to make those quarterly estimated payments, and it truly would help you to pay those through payroll taxes throughout the year, then maybe S Corp is the right way for you to go. But let's talk about some of the ways in which that may be a short-sighted choice. The biggest one is that there is a deduction. It is called the Qualified Business Income Deduction. It is about 20% of the profit of your business that you don't have to pay income tax on. You're still paying that Social Security Medicare. We're not getting around that. But you're not paying income tax on that 20% of your profit. And that is a really great deduction. Ever since in 2018, that became a thing in its current form. It has made less sense to make that S election. Any savings that you had in Social Security Medicare tax, you were losing out of some of that qualified business deduction. So to explain a little better, That 20% deduction is based on the profit of your business as a sole proprietorship. But as an S corporation, it's only based on the profit of your business after you deduct your wages. So that really has been the greatest equalizer over this last few years. In this particular moment in time, it's also worth being aware that the big, beautiful bill that the House passed, that's now waiting to be negotiated in the Senate, and who knows what will actually pass. But this first draft of the bill increases that deduction from 20% to 23%. So it makes the math even less appealing to make that S Corp election. So QBI, qualified business income deduction, that's the number one equalizer reason that this may not make sense. The second one is extra costs and administration. Know that when you are taxed as an S corporation, that S corporation has to file its own tax return. You need a payroll service. Yes, you can do it manually on your own. I really don't recommend it, especially if you are here in Washington State. There are so many deadlines. It's so easy to lose savings in the form of penalties for missed deadlines. Pay a payroll service. It's generally $55 a month or so if you're using Gusto or QuickBooks Online Payroll, whatever online service you use. They're generally in that $50, $60 a month range for a one-person pay run. Highly recommended. Just do it. Those extra costs add up. As I mentioned, deadlines in Washington State. The other thing to be aware of is that when you're on payroll, so when you are an S Corp owner on payroll, you don't have to pay into Washington Unemployment or Labor and Industries, but you do have to pay into Washington Cares and Washington Paid Family Medical Leave. So those are additional taxes that you're paying that you were not otherwise. Maybe that's a good thing. Maybe you want to pay into those programs and be eligible for those benefits later, but it's something to be aware of when you're looking at the math. Number 3 is retirement contributions. So depending on what type of retirement plan you choose to put together, if your goal is to fully fund retirement, then as a sole proprietorship, you can do that based on the profit of your business. No restrictions, other than the upper limits, of course. But as an S corporation, you are limited by your wages. So the lower you set your salary to save Social Security, Medicare, the lower your contribution into your retirement is going to be allowed to be. So definitely something to be aware of. It's one of those places where if you want to max retirement, you're putting your wages back up again, which is negating your whole point in the first place of reducing Social Security, Medicare taxes. So be aware of that. And the last thing I wanted to mention is reasonable compensation. So we've been talking about paying yourself wages from the business. Reasonable compensation is highly subjective. There isn't a hard and fast rule. There are people who say, there's this myth out there that says take 60% in wages and 40% in profit distributions. That 60-40 rule has never had basis in tax court. Don't rely on something like that. You want to rely on assessing reasonable compensation for your position. What would you have to pay someone else to do the work that you do with your experience level to fill your position, right? You have to have your business owner hat on and hire for your position. What would you have to pay? The IRS is very clear that 0 is not appropriate if you are taking money out of the business. If the business doesn't have money to pay you, then it's fine to not take a salary, not to take wages. But in that case, if the business doesn't have money to pay you, why are you paying the extra administration to be taxed as an S corporation? All of that aside, reasonable compensation is required. Reasonable is subjective. Make sure you have documentation for how you determined what is reasonable, but just know that is something the IRS looks at. It is a line item on the tax return. It is something that they could pull reports on and audit on. So it's definitely something to have your T's crossed and I's dotted. So to look at a very quick example, I've rambled on quite a while. But to look at a very quick example, talking about this taxpayer with $100,000 in business profit and $60,000 in reasonable compensation. Again, I did just say don't use the 60-40 rule, but it was a relatively reasonable number to drop in just for the sake of example. So in this particular instance, under the sole proprietorship, like we talked about, they're paying basically 15% Social Security Medicare tax, and then they're paying income tax, which again, these are just estimates. Don't quote me on this, but roughly the tax comes out to about $27,000 for the year. Again, very painful. But now if we go over here and take the same $100,000, except $60,000 of it is wages, they're paying about $9,000 in Social Security and Medicare. They're paying federal income tax and Washington state payroll taxes, about $27,000 as well. The equalizer again here being that qualified business deduction, where the sole proprietorship is getting a deduction of $18,500 that they don't have to pay income tax on. The S corporation is only getting a $7,000 deduction. So between the two, it's really a break even at this particular moment in time for this particular entity. But then you factor in the extra tax preparation fee, and which is conservative here, the extra cost for payroll processing, and now we've got a business that has paid an extra $2,000 for the privilege of operating as an S corporation. So just some things to think about. Again, your facts and circumstances may be very different from this facts and circumstances. Your goals may be very different. If you don't care about the retirement contribution, if you're in an industry where you really could put anybody in your position at a very low pay rate, but still have quite a bit of profit, if you already have employees, then the extra cost of payroll processing maybe isn't a thing for you. If you're already taxed as a partnership, then the extra tax preparation fee may not be a thing for you. So many different factors for every situation. I tried to simplify it as much as I could to just give the gist. But again, please consult your tax pro to really analyze your situation. Hopefully this is helpful, but I would love to know if you have any follow-up questions on this topic or questions on any tax or business topic. Feel free to drop those in the comments below. Click like if this was helpful. Feel free to subscribe if you'd like to be notified of the next video, and feel free to follow me on Twitch. I do co-working stream Wednesdays from 12 to 2 Pacific if you'd like to come hang out. I hope you have a wonderful rest of your day. Thanks again for listening, and we'll see you next time.